learning from the article that is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves.
Good evening, everyone, from Chicago. It's Thursday, August 13th. I'm your host, Charles Brown, Portfolio Manager with CB3 Financial. We're so glad you've joined us tonight. We've got a really great show for you, so buckle in, and here we go, okay? From COVID to clarity, this is CB3 Live. Tonight's top three, the coronavirus still ebbing nicely, but some school openings are in doubt. Very special guest tonight, Bill Kelleher, CMT CFA. Bill and I are going to talk investing in today's markets. I think you're going to love this segment, and we're going to want questions from you. So the minute we start sending us questions because of the delay, okay? And then the markets have hit kind of a summer doldrum, although the S&P hit an intraday lifetime high today. It didn't hold it into the close, but it hit it, and that's a great sign. If you have not yet subscribe to me on YouTube, please do that so you get the notices for the Monday night and the Thursday night shows. I am tweeting every day, sometimes twice a day, so be sure to follow me on Twitter, and you'll be kept up on everything that we're doing, okay? So, the Monday Market Mashup, many of you have started to watch this. We know because the viewer count's almost the same as what we have here on Thursdays, even though it's a much shorter show. We're glad you're watching. Gives me a chance to look at what's going on early in the week and get that to you so you don't have to wait till Thursday. Corona America, what is happening? Okay, here's the stat that we always start with, the latest numbers, and they're in green this week. I'm sure you're thinking, how can I possibly ever put these in green? The total confirmed cases right at 5.2 million. The death count at 1,500 per day, even though that's still human lives lost. This number is coming down. This trajectory is ebbing finally, and that's great to see. I showed this slide last week, and I want to do it again this week because what does 1% mean? I mean, the numbers that you're hearing in the media are not necessarily the numbers as they play out here. In the 1984 Spanish flu, 50 million people died with a world population of 950 million. That's 5.2% of the world that died in 1918. And by the way, we were in World War I at the same time. That is a tragic event. And not to downplay, but the reality is in 2018, the seasonal flu killed 650,000. The world population at that time was 7.5 billion. So that's less than 0.009%. Sadly, folks, that's a typical year. Now in 2020, COVID-19, 488,000. That number's a little low right now. You saw on the previous slide, it's over 500,000. World population, 7.7 billion. That's 0.006% of the world's population. I am in no way minimizing the tragedy of human loss, but we do need to keep this in perspective. When we talk about opening up this economy, these are numbers that are manageable. No one wants to lose anyone, a job, a person, a family member, but these are manageable, and that's what we're trying to do right now. Haven't showed this slide in about 6 weeks, but this is a graphic of how you get the virus. Now, I part ways with those on the right in that I wear a mask everywhere I go, and I realize that that's not a conservative thing to do. But here's the reality. Somebody coughs, talks, breathes. If it gets inhaled by you, gets into your bronchial system and then replicates, you're going to get COVID-19. If you're wearing an N94 or N95 mask, you have a far less chance of getting that. So I'm encouraging you, wear the mask and stay 6 feet away. We've just got to do this. Over the last several weeks, I've talked to you about Moderna, and we have not invested in Moderna. And some of you have wondered why not. And you know what? I may look back on this and say that was one of my biggest misses. We've had some wins, but this is a miss, at least right now. But I believe once this vaccination is announced, and the government has already stepped up and say we've signed a $1.5 billion contract with Moderna, there will be a pullback and an opportunity to invest, and I think that's a safer play. But the good news is that the government is literally standing there with money in hand waiting for Moderna to release this vaccine, and that's a great thing. And here's why, again, not on the people side, but on the financial side. That is what our show is about. Look at this graph. The top line is the most likely scenario for GDP recovery. Why is this important? Because GDP bottomed out in April of this year. You can see that arrow down there, and there has been a V recovery, although it's going to slow down to get back to where we were in February of this year. The trajectory right now is October or November of 2021. You might say that seems like a long way away from August 2020. But folks, that's an 18 to 19 month recovery. That's an astounding recovery considering what the market did between February and March 23rd. Now, those other lines are represented if the vaccine takes longer, if it doesn't come out until the 2nd, the 3rd, or the 4th, or even the beginning of 2022. So we want the vaccine as soon as possible. I realize that's a duh, but I wanted to do this research for you so you could see that this is plotted on a graph, okay? As bad as it seems here in the U.S. GDP dropping, look at the UK, Spain, France, Italy, Germany. Look where we are in comparison to that. Again, you're not getting this in the news. I got this from the UK Office of Statistics, Eurostat, which reports on the Eurozone, Bureau of Economic Analysis here in the U.S. First quarter is the dark bar. Second quarter is second quarter is the dark bar, first quarter is the light bar. So the GDP drop has been way more dramatic overseas than it has been here in the US. And if we take this back 3 quarters on this chart, the gold percent change down 10% is the US. Look at Spain at minus 22, France at minus 19, Euro area 15. We're far better than our European and Asian fellow countrymen. We really are. Again, you're not hearing that story in the media, but that's the hard data. One way that I measure the effectiveness of pulling out of this recovery are the initial claims. Now, normally it's the monthly employment report that I talk to you guys about. That happens every 4th Friday or the 1st Friday of every month. But every Thursday, there are weekly initial claims. Today's report was especially encouraging. This is literally just 10 hours ago. The key takeaway, as you can see in yellow here, is that it was the first time that initial claims was under 1 million. Now, I realize, again, that 1 million is a staggering number. You can see in the last paragraph. That's 4 times larger than the norm has been for the last 8 to 10 years. It's normally anywhere between 210 and 250,000. So 1 million, that's still a ton more, but it's moving in the right direction. I've been committed to giving you guys not only the truth, but the positive truth when we have this kind of data. And I love seeing this. I just love seeing this. Straight from the Labor Department this morning. So what we're seeing is jobless aid dropping off. So that dark blue bar here, basically, yeah, the numbers went crazy early on in the process, but over the months here, the unemployment needs have dropped off. Okay? Now, this is a positive sign. This is the July non-farm payroll, which came out the first Friday in August. What are you seeing? Where are the biggest job gains? Leisure and hospitality, government, and that doesn't mean federal government, that means local government, even state and local government. Retail trade, education, okay, that's where the jobs are coming back. That's encouraging. That means we don't necessarily have a permanent depression in the restaurants and the airlines and the amusement parks, and now AMC has announced they're opening in 10 days after being closed for 5 months. We are seeing these distressed, beaten down parts, industry sectors and industry groups of the market coming back. And it's hard data, folks. It's hard data. This is really happening. Initial claims for unemployment insurance also dropping off. All you have to do is look at the graph and see it's moving in the right direction. Layoff notices declining once the PPP came into full force. Now, I think the PPP, we got our check about 10 days ago. It took a long time, but we got it. And as businesses are receiving them, it's reducing the number of layoff notices, and that's what we need. We needed the government to step in this pandemic, and you're seeing the results in May, June, and July. And I'm expecting when I show you this graph in August, you're going to see it's also positive there too. So the jobs boom, believe it or not, guys, in full swing. The economy generated 9 million new jobs in the last 3 months. So if you look at the point down there, which is April 15th or so, the lowest point of job loss, look at where it is now, okay? Expecting a loss of 3 million jobs during this time frame. We're actually up 9 million. That's a positive swing of 12 million jobs. Again, this is from the Labor Department, the U.S. Labor Department. If you can trust their news, you can trust anybody's. Here's another stat you're not going to see. We hear 10, 12, 14 unemployment percent. First of all, it's down to 10.2 now. But for those who have college educations, it's 6.7. Now, I realize that there is a gap in America, and there's another slide coming up that you're going to see this as well. But the reality is that the people who have the higher level of education are not experiencing the same unemployment risk that those are with lower education. I'm hopeful that this gives millions of Americans an incentive to go back, irrespective of their age, and get some additional schooling. I really hope so. Now, the percentage of households cost for housing. What percentage, if you make $100, are you spending 30% of that, 20% of that, 40% of that on housing? This is where we're seeing a diversity among, or a divergence, I should say, among people of color in America. Blacks, Hispanics, others, Asians spend a higher percentage of their income on housing. I'm not a social scientist. I can't answer this, but I'm just pointing out this because this affects spending patterns. Again, this is a financial show that has to focus on, where the trends are, because that's what I'm trying to do for you guys, is invest for you. When people have less discretionary income, people of color have less discretionary income, which is what the data is showing, it could change spending patterns, and just letting you know that we're watching this, okay? We're watching this. All right. Question of the night. When will the COVID-19 lockdown end? The lockdown will end by third quarter. That's answer A. Answer B, it'll end by the fourth quarter. Answer C, it'll end by year end 2021, which is next year. Okay? Or the lockdown will not end soon at all. So you guys are on about a 25-second delay. Type your answers in, A, B, C, or D, and I'm going to see who's asked me any questions in the channel. Oh, got Don and Kate there. Good. All right. Very good. Chris, hey, Martha. Happy Lefties Day. How about that? Yeah, I'll wish a happy Lefties Day to my daughter in Baltimore and my son in Chicago. They're lefties. How about that? Hey, Kay, how are you? Good to see you. Conservatives wearing masks, not just you. I'm glad, Nellie. Thank you. Especially people from Atlanta, right? You guys have had your challenges down there. All right, the day after the election. Kay, we got a B. Lockdown will end in the fourth quarter, Kay. Keith, it'll end on 11/4. That might just be the day after the election, Keith, I think. Dr. J, welcome. It's going to end by the end of the year, okay, 2021. That's a little later than I would like to see. Charles Todd, third quarter 20. Good to see you, Charles. Mark Burns, good to see you, buddy. Answer B, end of fourth quarter. Kate, B. Chris is either C or 11/4/2020. Keith beat you to that answer, Chris. That's good. Hey, Karen, how are you? I didn't see you earlier. lockdown in by fourth quarter. I mean, overall, you guys are pretty optimistic. It's going to have a 20 handle and not a 21 handle for that lockdown. Okay, Greg, you got an A. That's good. All right. I'm hoping that my optimism is rubbing off on you guys. This is good. I just feel great. I've been talking in the green room with our guest tonight, and I'm so excited to introduce Bill to you guys. This is just awesome. So Bill Kelleher, CMT CFA. So there's like less than 1,000 people in the world that have both of these designations. It took me, I won't even tell you how many hours it took me. Of course, he's younger than I am, but it took me forever to get my CMT. It's really tough. There's still less than 8,000 of us, but the people that have both. So I brought Bill on. Bill and I actually worked together about 4 years ago designing portfolios and stuff, and then he went off and became a superstar hedge fund manager in Boston. And we just recently reconnected, and I said, I bet my clients would like to hear somebody who's got, the same business but has different strategies. So Bill's the co-chief investment officer and the chief operating officer for Connecticut headquartered ETF Concepts. He manages a systematic hedge fund, so that's very different than what I do, but very cool, okay? And they use market timing, they have proprietary signals, and so guys, I'm just going to tell you right now, hey Heidi, I just noticed you joined. I'd like you to just pummel Bill with questions, okay? You got two different, portfolio managers on the phone here, on the video here, and just feel free to ask questions. I've doubled my allotted time for this segment tonight. The last segment is going to be a little shorter than normal, so you won't be here till tomorrow morning. But feel free to ask questions. Bill would love to answer them. Bill hails from Boston, but tonight he's coming to us from British Columbia. So we're actually in two countries tonight. Welcome, Bill. We are so glad you are with us, sir. Are you there? I hear you. Can you hear me?
I can hear you.
All righty. Very good. Yeah, maybe speak up just a little bit. So why don't you go into your background a little bit? I think you and I started kind of similarly. I was at the Mercantile Exchange. You were trading in Boston. You went to school in New England. Just tell us your background and why you wanted to get into the markets and why you chose the markets over the National Hockey League. That'll really interest people.
Well, it happened a little bit naturally, Charles. I wish I could have obviously pursued on my way to the NHL, but I did go over and play hockey over in Europe for a couple of years. But it gave me the opportunity while I was in college at Dartmouth College to take an internship on the Boston Stock Exchange, and that's where I fell in love with the markets. And obviously there's a lot of parallels between, sports and the markets, and it was a nice transition. So I worked at the exchange for 4 months of the year, and then I went over to Europe for 2 years and played hockey for 8 months. But it's funny, you did date me there a little bit. I'm dating myself now, thinking about, I've been doing this for over 20 years. I started interning at the exchange in 95 and started as an assistant to one of the specialists there in 97 for those 2 years, and then got my own book in 99. But it's interesting. The markets, most people don't think about the markets evolving very much. And I think I was lucky to have that experience early in my career, because as many of your listeners or watchers probably know, I caught the tail end of that big boom, that big tech boom we had in the late 90s. And I just learned a ton, at the beginning of my career. It's also a tough entry point when you start your career when you get your own book in 1999, and it's literally just about the top of the market.
So you started about 8 years after Peter Lynch from Fidelity, also from Boston, had quit.
That's right. And the 90s were a great time to learn, and there's a lot of parallels to potentially to this market environment right now. And but to go back, I've really had to. I learned early on in my career that the markets evolve, and you've got to kind of stay ahead of it and adapt with it. When I started trading, we were trading in eighths, and I'm not sure how many people remember, trading in fractions. We went from eighths to sixteenths in the late 90s, and then shortly afterwards, in the early 2000s, is when we finally went to decimals. And
let
that's
me
when
just
the
do a
game really
quick
changed.
interjection there. So, folks, when Bill and I started, you bought a stock either at 125 and an eighth or 125 and 7/8. Obviously, it's easier to make money when you have that much leeway between the bid and offer. When it started trading in pennies, it became tougher, and that's when so many things came upstairs, so to speak, rather than a trading floor. Sorry, Bill, go ahead.
No, and that's what led me to, we realized, working on the trading floor, I realized at that time that the game had changed and I needed to be a much better trader, a much better market participant. And that's what led me to the CMT Association, which you had just referenced. So I maybe started, a lot of people start with maybe their CFA, which is the fundamentals and the financial analyst, or the CFP. But I always worked with price, and so I knew I had to become a better trader, and so I really started to study a lot more technical analysis, which led me to the CMT Association.
Yeah, and so I've told my clients, the reason I have a CMT after my name is because I really fundamentally always wanted to be a trader. So many people in our industry have a CFP, and there's nothing wrong with that, a certified financial planner, and they understand insurance and tax and all of that. And candidly, if my current client book needed experts in that area, we have professionals we would send them to. But CMTs understand price. And I think you and I are on exactly the same page. Now, we approach things differently. So, as you know, clients that are on the phone, and if you're not a client, that's fine. You don't need to be. You never have to be. But my clients know we buy, so we're long only. We don't short the market. But what Bill does with really great results is a very different strategy than what we call long only. I do what I'm comfortable doing with success. But Bill, tell us about your strategy, just because I want our clients to understand that you can have. There's probably 150. There's probably way more than that. I don't know, 2,000 different methodologies that can all be successful in the markets, and we just happen to have two different ones.
Yeah, and I think it's important. I think it goes back to your time frame, and the beautiful thing about the market is it's a giant ecosystem, where you have players that are executing on a number of different strategies, coming from all globally. Everyone's investing in the market, as well as different time frames. And it's one giant ecosystem that all comes together with all these participants, and it all funnels into what's currently happening in the market. And so it provides great opportunity for different types of strategies or different types of investors. And so our strategy is a little bit, and again, I can't talk too much about the specifics of our
because it's
fund,
proprietary. Yeah, I get that.
I'm happy to give my outlook and my outlook of perspective of how I approach the market, and it parallels with our systems within our indicators that we've built. And to go back with the CFA and the fundamental side, as you referenced the CFP, I think it's important to realize there's a difference between, say, Apple the company and Apple the stock.
Sure.
Sometimes there are technical factors that probably influence price more, and versus a lot of fundamental factors that you can look at Apple the company.
Well, the perfect example of what you're saying is Moderna. I just talked about Moderna. I love what they're doing, coming up with this vaccine, and they and Pfizer are just in this pony race, this horse race to get done. But that doesn't mean that I want either of the stocks right now as a risk factor. The reward to risk is just high. Love the company, not ready for the stock. That's essentially what you're agreeing with me on, I think.
Yes, no, 100%. And you referenced the small number of technical and fundamental, or CFAs and CMTs. And, for so long, the industry really wanted to pit, the fundamentalist versus the technical analyst. And in reality, they're more complementary than adversarial. But it makes good TV Sure. if you bring on a fundamental analyst and a technical analyst and you try to get them to debate out their view of a stock. But in reality, price and value have a strong relationship.
I always thought if Jerry Springer, you couldn't, come up with new ideas, he would put a CFA on one side and CFP in the middle, and then a CMT on the end, and have them bicker. So So in your experience, when you speak to your clients or your service people do at your firm, when the markets are volatile like this, I had a half a dozen maybe clients come to me and say, "You sure we don't need to go to cash? You sure we don't need to go to cash?" And I just felt very strongly that we should not. And nobody bailed on me. They hung in, mainly because everything happened so fast. I mean, it's really hard to make adjustments. This wasn't like 2008 and then the recurrence in 2009. This just like, boom, 32% in 4 weeks. So how do you guys deal with that relationship management as you talk about your strategy to your clients?
Well, again, for us, I can't talk about the specifics of the fund, but we invest. We have investors that invest in the fund, and our strategy is actually, we talked about markets evolving and the trends in markets, and as we've seen in the market, data has become very important, and processing data and platforms that can process data. And so our approach has evolved over time, and it's much easier to execute now than it was 20 years ago.
Sure, because of the volume, technology,
in financial products. So what we do is we've built some indicators, and so we've taken the emotion out of the market. So we take a statistical approach to the market, and we try to capitalize on everybody. We talk about that ecosystem again. So we're capitalizing on the ecosystem, on the changes of expectations, or you might call it the behavioral finance or the behavioral analysis.
Yeah, go into that a little bit more, because we talked about the ecosystem. We're definitely on the same page. And behavioral, there's a whole behavioral finance, a study of two semesters worth in a college course. Behavioral finance is a really big deal because people tend to make decisions with emotions when they should be fading their emotions. That's trading lingo for doing the opposite of what their emotions are telling them.
Yes, it goes back to, again, earlier when I was talking about valuation. Valuation. In the longer term, prices should converge to value, to intrinsic value.
Sure.
The markets should over the longer term. But we have this short to medium time frame. Call it, weekly to monthly to quarterly to even within a year. That prices dramatically move. They shift, and it's value. If you think of the inputs, what inputs go into valuation, they don't change rapidly. So the information you get from the quarterly meetings from the analysts or from the company, you're only getting updated really maybe 4 times a year. But you see price move quite a bit, and that's a change in the ecosystem. That's the change of investor expectations for, say, that company or for, say, that stock, really.
Yeah, it's just investors expecting. I want to, rather than go on to my next question, let me handle some questions here. So from Keith, hey, Bill, does a person need a degree in finance or math to become a CMT certificate holder? That's a good question. I can answer that, and you can weigh on it too. When you started, you didn't have to have a college degree, I think. But I think when I got mine, I had to show them my diploma from the Cincinnati Conservatory. But
yes, actually, again, it goes back to a couple things. You can actually learn a tremendous amount. The CMT is over 40 years old, and they've done a phenomenal job of curating some of the best work and some of the best literature.
Yeah.
And the actual books of the CMT are essentially chapters that have been taken, the best chapters out of a number of some of the top authors or some of the top technicians over time.
Who are CMTs themselves.
Most of them are CMTs themselves, and it's a great place to learn. But to go back to your question, to actually become a CMT, you also do need, it is a professional designation, so you do need work experience to actually in the industry to become to use the CMT designation.
Yeah, good question. From Nellie, what has surprised you the most about the markets in 2020? A lot of surprises. What surprised you the most?
Well, honestly, what surprised me the most is it's probably no surprise because how the rally off of the V bottom was, right. and the fact that we're back at pre-COVID highs, and as you referenced today,
intraday highs in the S&P.
So that's consensus. If I had to think about something that's non-consensus, I would probably say this isn't a surprise, but it's going to be interesting going forward. What happens with gold? Gold broaching that 2,000 level has been quite interesting. Dollar's gotten a little
silver
bit
at
weaker.
$26.
Silver at 26. Last time silver really started to make a move was I believe it was just pre-financial crisis. But we're getting to some, interesting levels here. So.
From Charles Todd, Bill, what do you think about naked short selling, not options naked short selling, and the SEC lack of enforcement? So naked short selling, Charles, you may need to clarify this, but I think you're talking about options where you're shorting an option, but you're not buying a protective option on top of that. You're not spreading. It's just naked short options. Is the SEC, the margin requirements have increased, certainly in February and March, definitely. Just like the commodities markets, margins increased.
I haven't followed, naked short selling, I'm assuming is maybe, not getting the borrow or not, maybe gaming the system a little bit.
Sure.
As far as shorting the market, we take advantage of shorting the market. I think when I was referencing earlier, market, what we quantify, what drives price in that short to medium time frame is like everything else in the market. In the short to medium time frame, or in general, it is supply and demand that drives price. Sure. Ultimately, what is an investor willing to pay for the market, for a stock? And we quantify that essentially supply doesn't change that much. So really what you're talking about is demand.
Where's the bid?
By demand, you can get a good sense of which direction the market's going to move. Or and again, it's just looking at probabilities. There's a great quote, Marty Zweig. I'm not sure how many people might be familiar with Marty Zweig, but he's maybe known as one of the greatest market timers of all time, and traded stocks in the 1980s, came up with some great indicators. But Marty always said, people always try to give, say you can't time the market, and that's true because that's not true. It's just hard to do. So
consistently, certainly.
Consistently, but Marty always said the biggest thing that people try to do is call tops and bottoms, and that's really not the idea. The idea is to buy a stock or an asset when the probability is greatest that it's going to go higher.
Correct.
And that's what we seek to do.
So I got one more question, then we'll continue with the other scripted questions. Got it here somewhere from Tom. What do you believe is driving the NASDAQ up and going crazy the past few days, especially yesterday? You and I talked in the green room about rotation. So you want to touch on that? In a healthy bull market, we want all sectors to win and all asset classes to win, but it doesn't always mean they do it at the same time.
Yeah, that's right. And, we have seen as we've gotten up to some of these, with the S&P coming up to the pre-COVID levels, but we did see three down days we talked about in technology earlier in the week, and that's been leadership. And, there's been rotation in the market, and, we're seeing money flow back into tech.
Yeah.
And that's
it's the biggest and most mercuric sector of the 11, without a doubt.
But we also have to think like tech is a little bit skewed. Really we're seeing, those mega caps, those five, the five big names right now. Sure. That's really been the leadership in driving the market. And they have we got to remember that, the NASDAQ's a cap weighted index and the S&P 500 is a cap weighted index. And it's very tilted towards those big, what we call technology names.
And of course, Apple's going to change the weighting on the Dow because that's a price-weighted index. And on August 31st, we're going to find out how much volatility that creates. I got one more question, and then we probably want to end. Hey, guys, thanks for all these questions. I probably should have allowed 30 minutes, but I'm glad you're interested. This is from Chris. Bill, with the indices near their all-time highs or exceeding it, in the case of the NASDAQ, or kissing it intraday like the S&P, do you anticipate there will be a large breakout when the indices move up past the highs, a run-up to the election, or is this a double top? And then there's a follow-up question on that. Do you anticipate hedging more against a Biden win or flowing towards a Trump reelection? That's a complicated question. Do you remember all that?
There's a lot there. And, again, we monitor the demand in the market on a daily basis.
Sure.
And, we're at some rich valuation levels, but there's great momentum in the market. If you look at the S&P 500, I think right now, if you look at forward earnings, and you're probably back to you're close to 2000 levels right here.
But did we have interest rates, Bill, in 2000? Did we have the same interest rates? My contention is valuations do not have the same impact because Jay Powell has played his hand. He said, we're not budging for 24 months.
It's 100%, and that's why you really have to continue to monitor the data and really see how the price action. That's why I believe the price action is so important here.
Sure.
And to continue to, that's a nice thing to have that, have the valuation perspective and the technical perspective, because there's always a gap between whatever your intrinsic, we talked about before, if you're looking at, corporate, if you're looking at the company's financials, you're going to come up with your own intrinsic value assumption for what a company's worth. But the other side of it is price, and that's what somebody's willing to pay for an asset, and the demand side of it. So there's always a gap between price and intrinsic value. And having the tools to be able to navigate that gap, whether it's going to continue to expand in the case of Apple, where the valuation is going to continue to expand. I think it was at 34 times earnings today, as it approaches the $2 trillion market cap. And there's enough investor demand there, or what people are willing to pay for assets right now, because you referenced it earlier. Interest rates are low.
Right. For sure. Let me handle this political question, and then we've got one last one. And guys, thank you for all these questions. This is because Nellie said, I want to hear Chris's answer. Do you anticipate hedging more against a Biden win? I presume that means buying puts or, hedging to the downside, or flowing towards a Trump reelection. In other words, I'm going to rephrase that. Yeah. In your set of input variables, you have quantitative, you have qualitative, and I'm sure you have political. Are those somewhat equally weighted? And I realize that it's a proprietary formula, but Biden and Trump have to be inputs into your sentiment, wouldn't they? Yeah.
Well, it's funny because we're, if you look at, again, if you look right now, we were talking about this in the green room, the VIX has been retreating. And, but if you still look out 3 months, the VIX is the volatility index is trading at a much higher level. And I do believe that, obviously this election coming up, is going to create some more volatility as we get closer to the election.
No question. Got one more question, and then I'm going to have to let you go. But this has been great. We're going to have Bill back. I can already tell, maybe even before the election. I'm not sure, as busy as you are, that you caught this piece of news. But I'm going to just tell you, just in case. I know you're from Boston, but did you hear that Tom Brady got traded? So the question is, can the Patriots with Belichick still compete in the NFL, assuming that there's a season? That was the question. They figured you might know.
Well, I would never bet against. I mean, we're sad to see Tom go. Obviously he was the face of the organization and just.
And you bought tickets in Tampa for their home opener, right?
Well, but I'll tell you what, though, nothing motivates a team more, and especially Bill Belichick's one of the best motivators. So I know that he's going to be pushing those guys every game in, game out. Yeah. Whether they have enough talent to go all the way to the Super Bowl, remains to be seen. But I do know you're going to get the best out of the Patriots every week this coming year.
I'm sure. Bill, thanks so much. Really, really appreciate it. Learned a ton. Guys, thanks for your questions. I'm going to forward these questions that are in the chat that we didn't get a chance to. I'm going to forward those to Bill, and he'll be able to give you a customized response. Either he or I will. Thank you so much for that. Enjoy your time up there in British Columbia, Bill, and we will see you next time.
Fantastic. Thanks for having me, Charles.
Hey, you bet. All righty. Guys, we're on to the U.S. economy. I'm sorry that ran a little long, but seemed like the energy was there. The NASDAQ up 23% on the year. This is actually less than it was last week at this time because the other indices have caught up. The S&P's higher, the Dow's higher, still negative, but only 2.3%. The Russell in single digits. Guys, I expect all of these to be positive, candidly, by the end of this month. I think it's highly likely. NASDAQ still beating the S&P. NASDAQ's yellow, S&P's blue, still strongly beating. And this is my 100-year chart from Tom Bally. I just love this. I want you to lean into your monitor here. I'm going to do it, okay? Lean into the monitor and look at that itty-bitty little black line. This is a 100-year chart. That itty-bitty black line, get your magnifying glass out or put your eye right on the screen. That is the pandemic low from March 23rd. Okay, that's it. And if you look in 100, this is why I've been talking to you guys about recency bias. It seems like Chicken Little, the sky is falling, but it's not. It's just a blip in a long year trend. U.S. stocks leading the world. So what's the increase from the 2020 low, which is March 23rd? 50% increase since March 23rd for U.S. stocks. Nobody else in the world even comes close to it. Nobody even comes close to it. This chart I show you regularly, and I've been telling you that about 73% of stocks from Reuters news come in. So we're at 456 stocks that have reported, 44 still to report here for second quarter earnings. Obviously, we're in the third quarter, but we're reporting second quarter earnings. 81% have beat. That is a big deal, okay? Look at the data here. 34% year-over-year decline was what was expected. That's 11 percentage points better than what was estimated. In other words, there was a 45% estimation of earnings loss. It was only 34% instead of 45%. Those are still crazy numbers, but what's the takeaway here? The earnings beat rate, 81%. The surprise at 23%. I think, and I've been telling you this, and now Reuters and Bloomberg are saying the same thing. They think that there's an indication, that's why it's in italics, that the second half estimates may be too low, and maybe the third quarter estimates as well. The S&P came to the very brink and back in 175 days. Today, as Bill and I just mentioned, the S&P set an intraday lifetime high. It couldn't hold that high into the close, but it hit it intraday. It's just a matter of time before it closes at a new lifetime high. Tesla joins the stock split party. I love seeing stock split. Why? Tesla now 4 or 5 to 1. Apple's 4 to 1. I think Google, I think Amazon, I think Microsoft, Adobe. There's some other high expensive stocks that I'm hoping are going to split. Why? Because psychologically for the retail investor, it's a lot easier to own a $300 stock rather than a $1,500 stock. And psychologically, you will see a bump of 5 to 8%. That's historically what it's been. Apple, $2 trillion. $2 trillion. A company worth $2 trillion. That's more than all but 15 countries in the world. Okay? And you're seeing the same from Microsoft, Amazon, not quite the same from Google, but it's going to be there. America is the home of the trillion-dollar companies, even in a pandemic. Look at this jump here in inflation. Now, most people would be getting upset with inflation. You see that spike there at the end of the chart? Inflation often happens in a recession. But we're looking at a spike of 0.5%. The scale on the left-hand side makes all the difference. This isn't 3 to 5%, guys. This is 0.5%. We want to see prices firming. Why? Because it means people are willing to pay up for the goods and services that they want. A little bit of inflation post-pandemic as we move out of this recession is positive. It's a good thing. This is the data that I want to show you. Now, there's too many lines on here for you to pay attention to. The green one's all you care about, okay? That's average hourly earnings. And you can see that that line's above all the other ones. Those are CPI, so the Consumer Price Index, the Producer Price Index. Earnings are outstripping inflationary factors. You don't get that from the news sources. I don't know why they can't at least give you one piece of good news. But this is it. This is also from Reuters. earnings, that spike that you see with people going back to work, are out earning inflation. That's a big deal. I've been continuing to say how well the home builders, I should say, are doing. Actually, the homeowners are too. I'll get to that in a few slides. But home builders, look at this and how they're outperforming the S&P 500. And I had one guy, there's always somebody. It's like, I don't believe that data. You got to show me something else to make it believe it. Okay. So for my future trader friend who's watching tonight, this is lumber futures. Okay, I talk about the futures market, gold and silver, the S&P and bonds, but tonight I'm talking about lumber. You see that little red dot? That's the highest point on the chart in 20 years. What does that mean? That means lumber. That's wood. Okay, they sell futures in that because people need to hedge risk, and it's at the highest level in 20 years. Look at that spike. You don't get that kind of spike unless there's massive demand from home builders. That's another datum for you. Here's another datum. U.S. existing home sales, again, from the Daily Shot. It's a good data source. Higher than anything in 20 years, percentage-wise. Don't be looking for absolute numbers yet. This is percentage-wise swing. It's a great number. And why is this happening? I've shown you this chart before. This is refi data from LendingTree. All over the U.S., we're seeing 2.5%. I'm probably going to have to refi, and I just refied 6 months ago because I can get a 50 basis point or a 0.5% improvement in my rate. If you guys are not refining, it's worth the price of whatever you're paying to watch me here, to go out and look at what you're paying. The refi rates now are crazy, 15s and 30s. And because of this, it's a seller's market. I have a daughter that lives in Baltimore, and she's trying to buy a house. And this couple bought this home 3 years ago, and they're wanting $200,000 more for the house 3 years later. It's almost like the flipping in 2006 and 2007, because sellers know rates are low, people are hungry, they want to buy, and so that's what happens in supply and demand. Sellers are in the driver's seat right now. Now, I've been talking about the workforce dramatically changing. Look at this data from Google. 200,000 employees will continue to work at home until at least next summer. Zuckerberg is expecting half of his workforce to be remote within a decade permanently. And Twitter has told their staff, you guys are staying home. You're just staying home. That is changing the landscape, and it definitely affects our portfolios. We have not been in real estate, commercial real estate, in months. I would almost argue 3/4 of a year. But we're watching this trend, okay? All right, we're getting there, guys. Thanks for being patient. I know it's running a little long tonight, but what is the significance to you of this week's economics report? Type an A if you feel more encouraged, a B if I remain discouraged because of a really bad second wave, and I know we are getting a second wave. Certainly more in Europe than we are here, although certain states in the U.S., the southern states, are pretty bad. C, human nature is negative, but I believe in the best. Or D, not really sure what to think. Let me check the questions here while you guys are typing those answers in. Okay, and Chris, I'm just going to go back. I know Bill's not on the line right now, but I do not see there will be a large breakout or breakdown with Biden winning. My poll numbers are showing about 63% Trump re-election right now, which contrasts with almost every other poll out there. I understand that. Okay. Do trimmed margins and efficiency efforts massive upward move in the markets? I'm going to send that over to Bill because I need to keep rolling. Ventures cash injection market create a strong. It's great questions, Chris. Thanks for really responding here and following through. Can you provide thoughts on my two-message question above? Trimmed margins. Margins are going to be increased. They're not going to be trimming, and they're going to be increasing as volatility increases. That happens in equities markets, commodities markets, foreign exchange, currency markets. Low interest rates and cash being injected. When you see the 10-year yield rise with a 0.6 handle, a 0.7 handle, if it gets up to 1%, the S&P is going to be 20% higher. The S&P is doing what it's doing even with the 10-year yield at, 0.57 today? It's crazy. It's just crazy. All right, we got A. All right. We got a D here from Mark. Not sure what to think. Mark, You got to be an optimist, Mark. But I appreciate your honesty. Oh, because of the riots. Yeah, okay, now I'm seeing it. Okay, and I see you pasted your question in again, Chris. So, guys, thanks. And I'm keeping all these questions. If I don't get everything answered, if I've missed something here, now I know to not have such a long segment here when I have a guest like that. Not sure, Heidi says. Nellie A. Okay, good. I think in general, you guys sound optimistic. I hope it's because of the show. I hope it's because of other things happening in your life. But this is the channel for optimism, okay? So that's what we're trying to do here. Reminding you guys, our website is new. Those of you that are not clients, check it out. Do the 2 surveys on the front. It's just for your benefit. Find your risk tolerance. Put together a quick financial plan. That's what it looks like. All this is brand new on the site. So just a reminder, be sure you subscribe because we got some more guests coming up here. And I've got something really exciting to share with you guys here at the very end. I hope you're still with me. This is how to reach us. You just do a screenshot on this anyway, web, phone, Twitter, LinkedIn, Facebook. And so I normally end with this, and I've got a little bit more after this, but I just want to read this because this is so important from 2 Timothy. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. It is my deeply held belief that we will not only survive this pandemic, we will emerge a stronger nation and candidly a stronger market. Now, thanks for the kind words on the site looking better. Yeah, much does depend on the Durham report, Charles. Thank you for that. Guys, this is from me to you. This is a thank you for watching this program and giving me these questions and just the growth of our channel. I am excited to say that I have been asked to be a guest speaker, a permanent in the series of speakers on the largest technical analysis channel on YouTube. So there's 35,000 viewers. And they watched my show and they decided to give me 2 segments. And I had one of the really hotshot guys on the network ask me to be a guest on his program. So none of this would have happened if, first of all, my son Tom had not suggested I do this and go live on March 12th. So thank you, Tom. But second of all, it wouldn't have happened if you guys hadn't been here supporting the channel, encouraging me. Just know that I so appreciate it. I do. And I will let you know when I start posting these programs here on the Daily 5, which is the name of the program that's going to be on Stock Charts. So that's our program here for Thursday, August 13th. If you enjoyed, I think you enjoyed because we kept him on for a while, a lot of questions. I have another technician named Tom Bally who's going to join us for the September 13th show. Really excited about that too. Guys, just thanks for being here. It means so much to you. If my new friends in New Hampshire and Hudson are watching, we live free or die here at CB3 Financial. We believe in free markets, free country, free thought, and we are optimists. We want to encourage you guys to believe that the very best for America and the markets is up ahead. I will see you next Thursday night. From COVID to clarity, this is CB3 Financial.